Welcome to Ahead of the Curve from K33 Research. Today is August 11th, 2026. If you want to explore the data behind today's discussion, you'll find the full report at k33.com/research. Bitcoin has now spent 6 months going almost nowhere. Trading volumes are collapsing, volatility is close to 3-year lows, and traders seem increasingly unwilling to take a view in either direction. But there's an interesting tension beneath all that inactivity. Sellers appear increasingly exhausted. Long-term holders are absorbing coins again, and leverage remains high enough that when this market finally does move, the move could become violent. That's where we'll focus today. Let's start with just how quiet the market has become. Bitcoin is trading around $64,000, almost exactly where it was a month ago. Average daily spot volume fell another 18% last week to around $1.8 billion. That's the lowest weekly average since February 2024. Perpetual futures activity is even more striking. Combined trading volume in Bitcoin, perpetuals on Binance and Bybit, has fallen to its lowest level in 3 years. And volatility tells the same story. On Sunday, 7-day Bitcoin volatility briefly fell to just 0.6%. Outside the unusually quiet period around Christmas last year, we haven't really seen levels like that since 2023. This has become a self-reinforcing cycle. Low activity produces a slow market. A slow market gives traders very little reason to participate. And as traders step away, activity falls even further. CME remains unusually subdued as well, despite open interest recovering somewhat after the July expiry. Across almost every part of the market, the message is the same. Traders don't want to commit. And that brings us to the more interesting question. What does 6 months of this kind of price action actually tell us? Bitcoin has traded between roughly $60,000 and $80,000 for 6 consecutive months. It first reached a drawdown of around 50% from its all-time high back in February. Today, it is still sitting close to that same level. That's quite different from previous major Bitcoin bear markets. In 2014, 2018, and 2022, the market continued establishing progressively lower lows. This time, the price fell sharply and then essentially stopped. That doesn't necessarily mean the bear market is over, but it does suggest something different is happening underneath the surface. Sellers have now had 6 months, a 50% drawdown, and plenty of discouraging narratives to convince them to leave. Those who wanted out have had ample opportunity to sell. On-chain data increasingly reflects that. Coins moved from long-term holders towards shorter-term holders earlier in the cycle. Now, they're gradually moving back into the hands of a new group of long-term holders. In other words, supply appears to be getting absorbed. Buyers, meanwhile, remain reluctant. Bitcoin has been weak relative to other assets, and there is no obvious regime change forcing capital back into the market. So we end up with this unusual stalemate. Fewer motivated sellers, but not enough motivated buyers to push the market higher. That's why we continue to view this area as an appealing place to allocate to Bitcoin, even if there is little evidence yet that a new trend is about to begin. There is, however, one part of the market that makes the current calm worth watching carefully. Leverage hasn't disappeared. Trading activity in perpetual futures may be at 3-year lows, but open interest is still relatively elevated. Since the beginning of June, Bitcoin perpetual open interest has averaged just over 300,000 Bitcoin. That's above both the 2026 average and the average across 2025 and 2026. So we have an unusual combination. Very little trading, very little volatility, but a meaningful amount of leverage still sitting in the system. Funding rates have been moderately positive, but without a persistent directional bias. And because volumes are now so thin, relatively small changes in positioning can move funding rates significantly. The important point isn't whether the next squeeze will be up or down. The data doesn't give us a strong basis for making that call. The point is that elevated leverage can amplify whichever move eventually breaks this range. A market that looks completely dormant can change character very quickly once liquidations begin feeding into the move. There are also a few developments away from the price action worth watching. Bitcoin exchange-traded funds had their strongest stretch in several months. They recorded more than 8,000 Bitcoin of net inflows over the latest 5 trading days. At one point, 5-day inflows reached almost 15,000 Bitcoin, the strongest pace since early May. That's a meaningful improvement from the persistent outflows we saw during the second half of the second quarter. Although 1 week isn't enough to call it a new regime, strategy also continued doing something that would have seemed surprising not long ago: selling Bitcoin. The company sold another 1,690 Bitcoin to help fund buybacks of STRC while continuing to build its dollar reserve. That reserve now stands at roughly $4.65 billion, equivalent to around 2.7 years of dividend costs. The objective remains to push STRC back toward its targeted range around $99 to $100. So strategy is becoming financially more robust, but it's doing so partly by demonstrating that its Bitcoin holdings are available as a source of liquidity when needed. On the regulatory side, the Clarity Act has once again been delayed. Disagreements around ethics, illicit finance, and market structure have pushed the process beyond the August recess. A procedural vote is scheduled for September 15th. But that only opens the door for debate. It doesn't guarantee passage. For now, prediction markets are assigning fairly low odds to the bill making it through this year. And tomorrow brings another potential catalyst in the form of United States inflation data. But after months of watching macro events come and go without breaking Bitcoin out of this range, it would be a mistake to assume that one data release will suddenly change the entire market structure. So where does that leave us? Bitcoin is boring, but the boredom itself is becoming informative. 6 months around a 50% drawdown has given sellers plenty of opportunity to leave. Coins are increasingly being absorbed by longer-term holders. Exchange-traded fund flows have improved. Yet buyers are still reluctant to commit, and derivatives markets continue to carry enough leverage to make the eventual break from this range potentially much more aggressive than the current price action would suggest. The market may look asleep. The conditions for it to stay asleep forever are becoming less convincing. Thank you for listening to Ahead of the Curve from K33 Research. Subscribe for future market updates, and remember to check out the full report at k33.com/research.